We take a look at what next week has in store for the markets. On the monetary front, we note the release of RBA's March meeting minutes on Tuesday and the speech of Fed Chairman Powell on Wednesday. In terms of financial releases, we make a start on Monday with Japan's Tangan manufacturing and non-manufacturing indexes, both figures being for Q1, followed by China's Gaixing manufacturing PMI figure and the US ISM manufacturing PMI figure, both for the month of March. On Tuesday, we get the UK's nationwide house price rate for March and the US factory orders rate for February. On Wednesday, we get Turkey's CPI rates, the Eurozone's preliminary HICP rates, and the US ISM non-manufacturing PMI figure, all for the month of March. On Thursday, we note Switzerland's CPI rates, the Eurozone's final composite PMI figure, and the UK's final services PMI figure, all for the month of March, followed by the US weekly initial jobless claims figure and Canada's trade balance figure for February. Lastly, on a busy Friday, we get Germany's industrial orders rate for February, UK's Halifax house prices rate, US employment data, and Canada's employment data, all for the month of March. The greenback is about to end the third week in a row in the greens against its counterparts on a monetary level. We note the intensifying rifts between Fed policymakers regarding the bank's direction. Overall, we believe that the tug of war may emerge from Fed policymakers over when it may be appropriate for the Fed to begin easing its monetary policy stance, and thus could keep volatility high in the dollar heading into next week. On a macroeconomic level, we note that the GDP rate for Q4 came in better than expected, implying that the US economy is resilient in spite of the Fed's restrictive monetary policy. Yet, we must note that the core PCE rates for February, which are the Fed's favorite tool for measuring inflationary pressures, are due to be released this afternoon. Next week, the highlight for dollar traders may be the US employment data for March, and should a resilient labor market picture emerge for a third month in a row, it could support the dollar. We also note the release of the US ISM manufacturing and non-manufacturing PMI figures for March, which are expected by economists to improve and thus could support the dollar leading up to NFP Friday. The pound is about to end the week stronger against the euro and to a lesser degree stronger against the USD and the JPY. On a monetary level, we highlight BOE Mann's comments this week in which he stated that markets are pricing in too many rate cuts. The comments were made in addition to BOE Huskell's comments that interest rate cuts should be a long way off and may have alleviated some of the bearish tendencies for the pound since last week's interest rate decision. Should more BOE policymakers adopt a more hawkish stance, we may see the pound slightly recovering some ground. Yet, in our opinion, for the pound to recover some ground against its counterparts, it may need a helping hand from external forces besides BOE. As the GDP rate for Q4 came in as expected at minus 0.3% quarter-on-quarter, validating worries that the UK economy continues to remain within negative territory, entering a shallow recession, tending to darken the macroeconomic outlook of the UK. In the coming week, we note the release of UK's nationwide house prices for March and the final services PMI figure for March as well, although we do not anticipate these financial releases to materially impact the pound. JPY is about to end the week relatively unchanged against the dollar, the pound, and the euro. The main event of the week for the yen was the JPY nearing its historic 34-year low against the dollar. In particular, the weakening of JPY prompted Japan's Finance Minister Suzuki to warn the markets that Japanese authorities would take decisive steps, the same wording before a market intervention in the past, hence speculation of a possible imminent operation by the Japanese government to save the yen is on the rise. On the flip side, BOJ board member Tamura highlighted the need for a steady yet slow monetary policy normalization, while BOJ Governor Ueda was reported stating that BOJ must continue to support the Japanese economy with easy policy. The comments of the two BOJ policymakers were a painful reminder that the bank may keep a rather loose monetary policy for a longer period. Moreover, the release of BOJ's summary of opinions for the March meeting tended to verify comments expressed by BOJ policymakers for a slow and long road toward monetary policy normalization. The release had little effect on the JPY, and on a fundamental basis, the warning issued by Japan's finance minister, as mentioned above, seems to keep the JPY in check, preventing it from further devaluation, at least against the US dollar. The common currency seems about to end the week unchanged against the US dollar and JPY, yet weaker against the pound. On a monetary level, we note the comments of ECB chief economist Lane on Monday that he was confident that inflation was on track when referring to the bank's 2% inflation target, which may have weighed on the euro. On a macroeconomic level, euro traders may be interested in the release of Eurozone's preliminary HICP rate for March, which is expected to come in at 2.5% year-on-year. Should the rate come in as expected or even lower, it would indicate easing inflationary pressures in the euro area, thus potentially opening the door for rate cuts by the ECB, as was highlighted by ECB Lane, which in turn could weigh on the common currency. On the other hand, should the preliminary HICP rate come in higher than expected, thus implying persistent inflationary pressures, it could provide support for the euro. Lastly, euro traders may also be interested in the release of the Eurozone's final composite PMI figure for March and Germany's industrial orders rate for February, yet we believe these to be secondary releases and would place a greater emphasis on the release of the Eurozone's preliminary HICP rates for March. AUD is about to end the week relatively unchanged against the US dollar. On a fundamental level, we revert to our reference of Australia's reliance on China as a major trading partner, and as such we delve slightly into recent developments in China. In particular, it appears that China is increasingly attempting to thaw relations with the US in order to boost China's domestic economy, which could be seen as a positive for the Aussie. Furthermore, China's manufacturing PMI figures for March are due to be released over the weekend and on Monday's Asian session, and should the overall economic activity in China improve, we may see the Aussie getting some support. Any negative divergence, however, could have bearish implications for the Aussie. On a macroeconomic level, we note the persistence of inflationary pressures in the Australian economy that may harden the stance of RBA. On the monetary front, Aussie traders may be interested in the release of RBA's March meeting minutes, which is due to be released next Tuesday as an attempt to gain insight into the bank's inner deliberations, which could determine the bank's next direction and by affiliation, the Aussie's direction as well. The CAD is about to end the week stronger against the US dollar. On a monetary level, we note the speech by BOCW Governor Rogers, who on Tuesday implied that current interest rate environment could be hindering investments into the Canadian economy. As such, the hindering of potential economic activity due to restrictive monetary policy could influence the bank's stance to potentially adopt a more dovish tone, which in turn could weigh on the loonie. On a macroeconomic level, the clue about Canada's economic outlook seems to have been optimistic, with Canada's GDP rate for January coming in better than expected, which could support the loonie. On a deeper fundamental level, we note the positive correlation of the CAD with oil prices. Oil prices for the current week seem to have moved higher, which in turn may have also aided the loonie given its status as an oil-producing nation. For next week, we note Canada's trade balance figure for February, yet the highlight for loonie traders could be Canada's employment data for March, where should a loosening labor market picture emerge, it could weigh on the loonie and vice versa. Overall, we expect volatility in the FX market to intensify given the increase of high-impact financial releases next week. We may see the US dollar regaining some of the initiative in the FX market to other currencies. As for US stock markets, we note that equity bulls appear to be in the driver's seat for Dow Jones 30 and S&P 500, whilst appear to be facing difficulties in Nasdaq. At the same time, we note the problems faced by Apple, Microsoft, Google, and Amazon in Europe over alleged violations of the Digital Markets Act, an issue which could weigh on each company's respective stock price. Moving now to the gold market, gold's price rallied once again, breaking its prior all-time high figure of 2,222. Gold's price may have benefited from the relative inactivity of the US dollar. In addition to that, also the continued decline of some US yields may have allowed gold's price to rise. We expect in the coming week the negative correlation between gold and the US dollar to be on display. Hence, should the USD gain traction, we may see some bearish tendencies developing for gold's price. Ending it all, we note that today and on Monday it's to be a public holiday and markets are to be closed in the US, Canada, UK, Germany, Switzerland, Norway, France, Sweden, Australia, Czech Republic and New Zealand. So some thin trading conditions may apply. Traders who opt to operate in these days should keep their guard up for any unexpected market reactions. We hope that you found this report useful, and from all of us here at IronFX, best wishes for solid trading.
I guess we'll just go ahead and get started now. So, first things first, as per usual, a disclaimer. So, products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. A disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of material is strictly prohibited. Okay, so I'm Melanie and I will be your speaker for today's webinar on support and resistance. So here's our agenda for today. Firstly, we'll be looking at using swings for support and resistance levels, followed by looking at where exactly you should place your starting points. And then we'll be going into pullbacks and overlaps and combining these two in order to use these with Fibonacci as well. Okay, let's get started. So firstly, we'll go into how exactly you can use swings for support and resistance levels. So support and resistance levels in trading basically refer to prices at which an asset's price tends to stop falling, which would be your support, or stop rising, which would be your resistance. So to identify these levels, you can use technical analysis tools such as trend lines, moving averages, chart patterns, so on and so forth. Additionally, you can also look at previous highs and lows of the asset, as well as volume data to identify potential levels of support and resistance. So this is basically what we will be focusing on today. And it's important to note that these levels are not absolute and can change over time. So continuous monitoring is necessary. So I've added an image here for you to see how exactly we can use swing highs and lows as resistance and support levels, but we will go through it more in depth in the next few slides. So take note of how there are clear peaks and troughs in the market structure, and these areas can be used as your support and resistance levels. Okay, so firstly, let's look at an example of insignificant swings. So these are bad points to use for Fibonacci starting and ending points, but they're also not exactly good to be used for resistance and support levels. And I've shown you an example here in the GIF. So you can see that the price movements are really small and there's no significant swing highs or lows. Here's another example. So once again, there aren't really very clear swing highs or lows, and price movement is very small. Okay, and now let's take a look at a correct example of significant swings. So here you can see that there is a clear move up and down with obvious peaks and troughs and clear market movements basically. So in this GIF, that's basically what you are looking for when you are deciding on a chart to analyze on. So people may ask like which time frame do you use, which time frame do you recommend? And it's completely up to you. It depends on what kind of trader you are. So if you're a scalper, of course, a smaller time frame would be better. And if you are a swing trader, a longer time frame would be better. Okay, but still, when deciding which time frames to use, a important consideration is also the clear market structures. So you want to look for something like this, a clear market structure with significant swing highs and swing lows. Okay. Okay. So support and resistance. You can use these levels as take profit and stop loss levels, but you should not use it as an entry if there are no other supporting arguments, such as Fibonacci or other graphical levels to support your analysis. Using a recent swing high or a recent swing low is typically considered a weak level if it's just that level alone. So you can see in this GIF here, oops, in this GIF here, the recent swing high and lows, although they are significant, so you can see them very clearly, but they are not strong levels to use because we don't have additional Fibonacci levels to support them, and we don't have pullback or overlap support levels or multiple swing high or swing low support levels. So I'll show you what exactly I mean by that. So this is typically what you want to look for. So we're looking for multiple swings. So if at least two swing high or swing low levels line up nicely, these are typically much better levels to use. So you should try to find areas where these might line up, and it does not necessarily have to be at the exact same level because these tend to be areas more so than levels. So in this GIF here, you want to see how far you can, yeah. You want to see how far back your resistance or support line can go, and it's okay to cut through small wicks since support and resistance levels are usually in areas. Okay, so you can see here we have four swing highs that are about the same level, and we want to avoid cutting too many candlesticks, but if you're just cutting the wicks like in this example here, that's perfectly fine. Okay. So now that we know how to identify significant swings and use them as support and resistance levels, what are some things that we can look out for when inputting a support or resistance level? Okay, firstly, picking a starting point. So when picking the starting point of pivot, which is your entry level, support and resistance levels, these are typically your rules that you can follow. Excuse me. So firstly, we want to check if there is a swing high or low, and we've gone through those in the previous slides. We also want to look for pullback or overlap levels. So if you are wondering what exactly those are, I'll get into those in the coming slides. Next, we want to go as far back as possible. So as you saw in the previous slide, I did mention we want to try and pull it back as far as possible without intersecting too many bodies of the candlesticks. So we want to avoid cutting the thick part of the candlestick and just the wick. So just the little sticks on top of the candles, those are perfectly fine. Okay, so the orange thumbs over here represent an okay intersection. They're not preferred, but not exactly wrong. But preferably, we want to look for intersections that are only of the wicks, like over here. Okay, some more examples over here. You can see this thumb, this red thumb is what we want to avoid because it's cutting too many bodies of the candlesticks. So these green thumbs are what you typically want to look out for, where you are just cutting the wicks of the candlesticks. Okay. Okay. Another example here. Similarly, this red highlighted area, it's not preferred because you're cutting too many bodies of candlesticks. Okay, yeah, so the green thumbs, again, just cutting the wicks of the candlesticks. So something like this, would have multiple swing highs. We can just stop the support, or in this case, resistance. We can stop the resistance level just at this green thumb here. And it would already be considered a pretty significant level because we have 3 swing highs that line up nicely at the same level. Okay, which is important because you can see that price has tested this level many times before. Okay, next, let's go into the pullback and overlap. Let me know in the chat if you guys are aware of what exactly pullback and overlap level is before I show you guys the next slide. Okay, I think, yeah, because I do mention these a couple of times in our previous webinars, but no worries. Let's just go ahead and take a look at these. So firstly, we have pullback. So pullback, from the name suggests, we are expecting price to pull back to a certain level. Okay, so it's basically a strong level of support because it breaks out from a previous resistance level and price is now dropping back to visit it again. So in this case, we're just talking about the pullback support first. So if you take a look at the GIF, this is a pullback resistance. So just ignore that for now. Okay, pullback support is basically the opposite of that, where we are expecting price to retrace back to your support level. Okay, so a pro tip is when a pullback support lines up with a Fibonacci level, it's typically considered to be very powerful. For pullback resistance, these work well when it breaks a significant swing low and then starts pulling back to it. So it's even better, again, if there are multiple Fibonacci levels that are lining up with it. So here in this GIF, we have, okay, ignore the Fibonacci levels first because it is a little bit messy. But maybe I'll just refresh it. Okay, so here is our swing low for reference. Okay, so this is our swing low that we are using as a support level for now. But since price has already broken it and it's dropped below the support level, it's then a resistance instead. Okay, it's a resistance because we are expecting price to reverse off of that level. And that's why we call it a pullback resistance because we are expecting price to retrace back to the level and pull back to it. Okay, it is a little bit confusing, so let me know if you guys have any questions. But now if we talk about the Fibonacci levels. So here we are using a Fibonacci retracement. Okay, and I'm circling the 38.2 because it lines up nicely with my retracement. Once again, I have another retracement. In this case, the 61.8 lines up with my pullback resistance level. Okay, and now you can see that price really pulled back to our resistance and bounced off of it and headed downwards again. Okay. Okay, maybe I'll just let you guys watch the GIF one more time. So price has broken out of the support level, the swing low support, becoming a pullback resistance. Okay, and now that the resistance lines up with not one but 2 Fibonacci retracements, it's considered a confluence area. That's why I've highlighted it. Okay, and yeah, you can see price reversing off of the level again. Okay, so confluence areas typically are considered quite important levels because you have multiple Fibonacci levels or moving average levels or whatever that line up with your support and resistance. Okay, so those are is basically evidence that price is likely to respect that level again. Okay, so here's an example. Firstly, I have three swing highs that line up nicely. Okay, at this area, this red highlighted area. Price breaks out of the resistance area and it moves upwards. Okay, moves upwards, and once it breaks out of this area, it's considered a not Fibonacci, it's considered a pullback support. Okay, um, basically, when you have a resistance, once price cuts or breaks out of the resistance, it's then the opposite. So then it's a support instead. Okay, so then we call it a pullback support because we're expecting it to pull back or retrace back to the level, as you can see from the dotted arrows here. Okay, another example. In this case, we have a pullback resistance. In the beginning, we have three swing lows that line up nicely. Okay, so swing low, we would think of a support. Now that price has broken out of the support level, it's then a pullback resistance instead. Okay, so the pullback resistance, we're expecting it to retrace back to that level. Okay, another example here. So we have a significant swing low here over the circled area, and thus it is a possible support level. But now that price has pulled back and it has surpassed the swing low support, it is then a pullback resistance. Okay, so now let's see if price pulls back to this resistance level. And you can see that it actually did. Okay, so price has reached the pullback resistance level just as we expected. And once it reaches and reverses off of it, it will then be called a resistance overlap resistance level, which is what I'm going to get into in a little bit. Okay, okay. Next we have the overlap support and resistance. So an overlap support occurs when there are prices that touch the line from the top and from the bottom. So the more times that it reacts off of that area, the stronger the level is. So the reason for this is because it means that there are bulls and bears that are respecting that area, and therefore it's an important point to take note of. Okay, so once again, if your overlap area lines up with other elements such as Fibonacci or graphical elements such as your moving average or pivot points, for example, it will make it even stronger. So in this GIF, an overlap resistance happens when price touches it from the first point, which is over here, and from the bottom, which is here. Basically, when there is a swing low and a swing high that line up nicely in the same area. That's basically what an overlap level is. Whether or not it is a resistance or a support depends on what the latest where the latest point touches the line. So if it touches it from the top, it is a support. If it touches it from the bottom, then it's a resistance. Okay, here's an example. So the swing low support becomes a pullback resistance once price breaks the support at this 105.643 level. Okay, so you can see in this GIF how price retraced or pulled back to this resistance level and in fact reversed off of it, making it now an overlap resistance. Okay, so you can see here the minute that price, okay, here in the original image, price broke out of the swing low support. So once it breaks out of the swing low support level, it is then considered a pullback resistance. And once price retraces that level and reverses off of it, then it is a overlap resistance. Okay. Okay, let's move on. So now we're gonna combine both pullback and overlap levels. Okay. Excuse me. Okay, so here we have a big swing high resistance level, okay, at the start, and price surpasses this level over here. Okay, so the moment price surpasses this swing high resistance, it now becomes a pullback support instead. Now, price has made a pullback to our pullback support and has bounced off of it perfectly. So once price bounces off of it, it then becomes a overlap support instead. Okay, another example. So we have two swing highs that are lining up. You can see these purple circles here, and we have a swing high resistance from this. So price surpasses this level here, it breaks out of it, and then becomes a pullback support. Number three, point three, price has pulled back to our support and has bounced off of it twice. So the blue circles is where price bounced off of it. So once price bounces off, it now becomes an overlap support. Okay, I think by this time you guys probably have gotten the hang of it. So this is just my last slide, and then we will take a look at some charts. Okay, so once again, combination of pullback and overlap. Firstly, we have a multiple swing low here. Okay, 1, 2 circles here. Point two, pullback resistance. Once price breaks the multiple swing low support, it then becomes a pullback resistance, and then it reverses, pulls back to our resistance, and reverses off of it 3 times here. Okay, so once price breaks out of this overlap resistance, it then becomes a pullback support once again. So every time it crosses the level, it basically switches from a support to a resistance or from a resistance to a support. Okay, and then point five, lastly, price has pulled back to our support and reversed off of it. So this level at the 33420, you can tell that it's a very significant level because price is continually retesting it. Okay, so what's important here is that because it's a pretty significant level, you can also expect Fibonacci levels to line up nicely with this level. Okay. Okay, now let me pull out my trading view and then we can take a look at some charts together. Let me know in the chat if there are any specific charts that you would like to see. Okay. Um, okay, here are my charts. Okay, if there are no specific charts that you guys would like to see, I'll just go ahead and maybe analyze gold first. Okay. Oops. Okay. Okay, so this is an example of a really clear um, price movement. Okay, so we have three swing highs here, and you can see really clearly, the peaks here. Okay. Okay. So we have a swing high, multiple swing high resistance here at this level. Okay, and we can see price um reversing off of it. Okay, and this is on our weekly time frame. So we like to look at higher time frames first so that we get an idea of what the general direction of price is on a zoomed out kind of basis, and then we can compare with the lower time frames after. So once again, I'm looking at this on a weekly daily time frame. Okay, and I can see that we have this decreasing trend line. So I think in our next webinar next week, we will be talking a little bit more about trend lines and trend channels, but I'll just briefly go through what makes um, a valid trend line. Okay, so what makes a valid trend line is if there are at least 3 touches on a trend line. And if it is decreasing, your trend line should be drawn, or rather, if it's a downtrend, your trend line should be drawn like this from the top. Okay, if it is a ascending trend line, then we can draw it like this, so from the bottom. Okay, but of course, this trend line is not valid because I don't have 3 touches on it. But this is basically what you are looking for a ascending trend line. Yeah, so sorry about my throat. The weather is getting cooler, so I'm feeling a bit under weather. Okay, so now let's look at the 4-hour time frame. So we typically like to analyze either on the 4 or 1 hour time frames, and how we decide between the two is like I mentioned earlier, by looking at the chart structure. Okay, the price structure. So you can see on our 1 hour time frame, it isn't really nice to analyze on. And the reason for that is because price movement is like pretty small. Okay. It's quite small. But if we look at our 4 hour time frame, you can see that we have much clearer price movements. So that's basically what we look for. Okay, so I'm gonna analyze this on our 4 hour time frame. Okay, let's see. We're gonna start off by identifying the trend. So we can all agree that this is a descending trend line, right? Or rather a downtrend. Now I'm gonna see if I can find any graphical analysis to support that. So I kind of have a descending trend line here. Okay. Now that I've done that, the next step is to go in with support and resistance levels. Okay, here is my my second support, second resistance. My first, okay. I'm gonna see if I can find a closer resistance level. Okay, this level here is my first support. Okay, and then my first resistance, maybe here. And then my second support just here. Okay, so maybe just a recap. So my second resistance, I have a swing high here and a swing low here. So it makes it an overlap level. And then I also have another swing low here. Okay, so I have bulls here and bears, both of these areas respecting my second resistance. So it's a pretty significant level, and that's why I have labeled that. Okay, and my first resistance, I just have a swing high here. Price has kind of broken out of these levels. Okay, so I only have a swing high level here. Okay, and that's the reason why my next step is to go in with Fibonacci levels to try and support these levels a bit more, or adjust them and see if I have any better levels to use. Okay, first support is because it's the closest swing low to where price is currently at. Okay, and it also respects a couple of swing highs and lows. Okay. Second support, the reason why I put it there is because we have this swing high here and a couple of swing lows here as well. Okay. Yeah, and it's also basically the closest level to my first support. Okay. Now let's go in with our Fibonacci levels. Okay, so here I'm using a Fibonacci projection. Okay, and for Fibonacci projection, we use these three levels, and we use the tool Fib extension. Okay, that's on TradingView. If you're looking at MT4, I think it's also this symbol, but I don't think it's called an extension, but it basically has 3 points for you to analyze. Okay, and for Fibonacci X projection, just to recap, if you weren't here for our Fibonacci series, we look for a flash. Okay, a flash or like lightning bolt kind of shape. Okay, something like this. Okay, here, even though you can see my 78.6 lines up nicely with my first resistance, this is no longer valid because price has already broken out of the level. Okay, so I'm just going to keep my 100% here. That lines up with my first support. Okay. Mm, okay. Here I can see that this Fibonacci retracement lines up with my 61.8. The 50% is no longer valid because price has already broken out of it. Yeah, so just my 61.8. Okay, and this is a retracement. So for retracement, we use the 5 levels that I was using earlier: 23.6, 30.2, 50%, 17.6, and 61.8. Okay, I think that's all the levels that we have here. Okay, I think that's all the levels we have for Fibonacci. So the next step is to go in um with some indicators, and my favorite indicators to use are the Ichimoku and the MACD. For Ichimoku, I like to just look at the cloud, which is just the plots here. Okay, because if you look at all of the lines, which you can as well, but it is a little bit messy. Okay, So I like to just look at the clouds because at one glance, you can see exactly what the signals are. So if price is moving below the Ichimoku cloud like it is here, price is moving below the Ichimoku cloud, so it is a bearish signal. Okay, so it supports our analysis that price is likely going to continue to drop from the first support down to the second support. Okay, um, but over here, our MACD is giving us a bit of a bullish signal. You can see from the green here. Okay, and the reason for that actually could be because, as I mentioned earlier, our first support is here. Okay, and it's a pretty significant level with the swing highs, the swing lows. So it's an overlap support, and we can expect price to come back and retest this level, which is doing now, as you can see. And on top of that, we also have this 100% Fibonacci projection. Okay, that has not been it's not been surpassed yet. So we're still seeing price test this level, but because of the downtrend from this descending trend line, we saw on the daily, the weekly time frames that price is still pretty bearish on those levels, on those time frames as well. So we can expect price to continue to drop towards the second support because of all the downward pressure. Okay, but for now, it is still testing our first support. Maybe we can use another indicator. Okay, let me know in the chat what indicators you guys like to use. Okay, I like to use these three. Okay, on our RSI, we're also seeing a decreasing trend line. So it's also supporting our bearish signal here. Okay. Let me know if there are any questions. Oops. Okay. If there are no questions, I think we still have time for one more chart. So if you guys don't have any requests, I'll just go ahead and do maybe the Aussie dollar because we recently saw the RBA releasing a cash rate statement. So let's take a look and see how price affected the charts there. Okay, so same thing, I'm gonna analyze this on a weekly chart. Okay, let's see. Yep, we have a descending trend line on our weekly time frame. Okay, next, if we take a look at our daily time frame, also descending trend line here. Okay, remember the three touches here. Okay, next on our 4-hour time frame. So once again, I'm deciding between 4 or 1 hour, but both of these charts seem to be pretty clear. Maybe I'll just go ahead and analyze this on a 4-hour time frame. Okay. In this case, I don't really have a descending trend line, I think. Yeah. Let's see. Okay, I don't really have a descending trend line here. Okay, but we can definitely see that the trend is downwards. Okay. Now, I'm gonna go in with my support and resistance levels. Okay, this is my first resistance. And And my first support, maybe just here. And my second support here. Okay. Now we'll go in with some Fibonacci levels again. Okay, we don't really have very nice levels here. Okay, my 100% level lines up with my second support. Let me see if my 78. Okay, it lines up, but it's no longer valid because price is already broken out of it. Okay, so just my 100%. Next. Okay, I think my 38 lines up, yep, with my first resistance.